Just last week, something happened that sent shockwaves through the financial world. Berkshire Hathaway released its latest quarterly report showing Warren Buffett has been a net seller of stocks for 12 consecutive quarters, 12 quarters in a row. That is 3 straight years of selling more than buying. And the cash pile? It now sits at a record-breaking $400 billion. $400 billion sitting on the sidelines, not invested, not working, just waiting. The Oracle of Omaha, the man who built his fortune on buying great businesses and holding them forever, has been doing the exact opposite. He has been selling Apple. He has been selling Bank of America. He has completely exited S&P 500 ETFs like VOO and SPY, and he stepped down as CEO on December 31st, 2025. Now here is what nobody is telling you. This is not random. This is not retirement cleaning house. This is a warning signal. And if you are a senior with a 401k, an IRA, or any retirement savings tied to the stock market, you need to pay attention to what I am about to tell you. Because what Buffett is doing with his money tells a very different story than what the financial media wants you to believe. The Buffett indicator. That is the total stock market value compared to the entire US economy, just hit 223%. To put that in perspective, during the dot-com bubble in 2000, it peaked at 146%. Before the 2008 financial crisis, it was at 114%. Today, 223%, nearly double the dot-com peak. And Buffett himself has called this indicator the single best measure of where valuations stand at any given moment. So what does a 223% reading mean? It means stocks are priced as if the economy will grow at rates we have never seen before. It means investors are paying more for every dollar of corporate earnings than almost any time in history. And it means when this thing corrects, not if, when, the fall could be devastating, especially for seniors. Here is why this matters more to people over 60 than to anyone else. When you are 30 or 40 and the market drops 50%, you have decades to recover. You can keep working. You can keep contributing, time is on your side, but when you are 65 or 70 and the market drops 50%, that is a different story entirely. There is something in retirement planning called sequence of returns risk. Let me explain this in simple terms because understanding this could save your retirement. If you retire and start withdrawing money from your portfolio, the order of your returns matters enormously. If you get bad returns early in retirement, like a market crash in your first few years, it permanently damages your portfolio. Even if the market recovers later, you have already withdrawn money at the worst possible time. You sold low when you should have been holding. During the dot-com crash, the Nasdaq dropped 78%. People who retired in 2000 with portfolios heavy in tech stocks saw their nest eggs cut by more than half. Many had to go back to work. Many had to delay retirement by 3 to 5 years. Many never recovered fully. The 2008 financial crisis was even worse for retirees. The S&P 500 fell 57%. The median household wealth dropped 39%. People aged 55 to 64 saw their retirement accounts drop 25 to 40% in a matter of months. And this happened when they needed that money the most. Now look at where we are today. The market is more overvalued than both of those periods. And Warren Buffett is holding more cash than ever before in Berkshire Hathaway's history. Let me tell you what Buffett actually said in his 2022 shareholder letter. He described modern markets as casino-like, with feverish activity and foolishness marketed. He said the world is full of foolish gamblers and they will not do as well as the patient investor. In his 2019 letter, he warned that market drops of 50% or more are inevitable. He said borrowing money to invest amplifies ruin. His exact words, a string of wonderful numbers times 0 will always equal 0. Think about that. If you borrow money to invest, or if you have your entire retirement in stocks, and the market goes to 0 on you, everything you built disappears. Now, I want to be very clear here. Buffett has not issued some dramatic press release warning seniors about a specific date. The clickbait headlines you see online about 2 days left are misleading. They take his actions out of context. They use his name to scare people into buying gold or some other product. But here is what those clickbait videos get right. Buffett's actions are screaming caution. when the most successful investor in history is hoarding cash and selling stocks. You should ask yourself why. His 2007 shareholder letter, written before the 2008 crash, contained a line that became famous. He said, "You only learn who has been swimming naked when the tide goes out." He was talking about financial institutions that had taken on too much risk. When the crisis hit, those institutions collapsed. Lehman Brothers, Bear Stearns, Washington Mutual. Today, the question is, who is swimming naked now? Let me show you something else. Back in 1999, Buffett wrote a piece for Fortune magazine where he predicted stock returns for the next 17 years. Everyone was euphoric. The market had delivered 13% annual returns for almost 2 decades. People thought it would go on forever. Buffett said no. He analyzed the fundamentals: corporate profit growth, GDP, dividends. He concluded the next 17 years would deliver only about 4% returns after inflation and taxes, far below what everyone expected. He was right. The dot-com crash happened a year later. The 2008 crisis came after that. From 1999 to 2016, returns were exactly as he predicted. Modest, disappointing for those who expected the party to continue. His exact quote, "Investors in stocks these days are expecting far too much." Does that sound familiar? Because right now, the S&P 500's CAPE ratio, that is the cyclically adjusted price to earnings ratio, is sitting around 40. That level has only been reached about 3% of the time since 1957. And historically, when the CAPE is this high, the average return over the next year is a negative 4%. Over 3 years, negative 30% on average. I want you to stop and absorb that. The data shows that when markets are this expensive, they tend to fall, not rise, fall. Now let me talk about what this means for your specific situation if you are a senior. First, let us address Social Security. Buffett himself has warned about Social Security cuts. The trust fund is projected to run dry by 2033. When that happens, benefits could be cut by 23% across the board. That is not fear-mongering. That is the Social Security Administration's own projections. So, if you are counting on Social Security as your main income source in retirement, you need a backup plan. And if your backup plan is a stock portfolio that could drop 40 or 50%, you need a backup plan for your backup plan. Second, inflation is still eating away at your purchasing power. Buffett has called inflation a silent thief that erodes retirees' savings. Since 1965, the dollar has lost about 86% of its value. A dollar from 1965 buys about 14 cents worth of goods today. If you are keeping your money in low-yield savings accounts or bonds that pay less than inflation, you are losing money every single day. Third, high fees are destroying retirement accounts. Buffett made a famous 10-year bet starting in 2008. He wagered that a simple, low-cost S&P 500 index fund would beat a collection of hedge funds picked by experts. 10 years later, the index fund had returned 85.4%. The hedge funds? Just 13.7%. The difference was fees. Hedge funds charge 2% of assets plus 20% of profits. Those fees compound against you. Buffett estimated that over the past decade, investors have wasted over $100 billion chasing fancy fund managers who underperform simple index funds. If you are paying a financial advisor 1% of your assets every year, do the math. On $1 million portfolio, that is $10,000 a year. Over 20 years, with compounding, you could lose hundreds of thousands of dollars to fees alone. Buffett's advice: use low-cost index funds. He specifically recommends putting 90% in an S&P 500 index fund and 10% in short-term government bonds. This is the allocation he set up for his own wife's inheritance. Simple, low-cost, effective. Now here is where I need to give you both sides of this story, because smart investing means understanding multiple perspectives. Some analysts argue that high valuations can persist for years if corporate earnings keep growing. The AI boom is driving profits at major tech companies. Some say this time is different because technology changes everything. The counter-argument from Seeking Alpha says that betting on a 2026 crash could mean missing huge gains if the market continues higher. Markets have stayed expensive before during strong earnings growth, but here is my honest assessment. Even if the optimists are right and the market keeps rising, Buffett's approach protects you either way. Having some cash on hand means you can buy opportunities when they appear. It means you are not forced to sell at the worst time. It means you sleep better at night. And if the pessimists are right, if we see a correction like 2000 or 2008, you will be positioned to survive and even thrive. Let me now give you Buffett's actual advice for building and protecting a retirement nest egg. These are principles he has repeated for decades. First, never lose money. This is his number one rule. The second rule, never forget rule number one. This sounds simple, but it is profound. Most people focus on returns. How much can I make? Buffett focuses on preservation. How do I avoid permanent loss? For seniors, this means being realistic about risk. If you cannot afford to lose 50% of your portfolio, you should not have 100% of your portfolio in stocks. Period. Second, stay within your circle of competence. Only invest in things you understand. If you cannot explain how a company makes money in simple terms, you should not own the stock. This protects you from chasing the latest fad, whether that is crypto, meme stocks, or whatever the financial media is hyping this week. Third, avoid market timing. Buffett has said repeatedly, time in the market beats timing the market. Nobody can consistently predict short-term moves, not even Buffett. But over long periods, the market has always gone up. So stay invested, but stay invested wisely. Fourth, be fearful when others are greedy, and greedy when others are fearful. Right now, everyone is greedy. The market is at all-time highs. People are loading up on stocks, expecting the party to continue forever. That is exactly when Buffett gets cautious. Fifth, invest in yourself. Buffett says the best investment you can make is in your own abilities. Read, learn, develop skills. This applies at any age. The more you know about investing, the better decisions you will make. Now let me give you specific steps you can take starting today. Step 1. Calculate how much cash you need to cover 12 to 24 months of living expenses. Put that money somewhere safe. A high-yield savings account, short-term treasury bills, something that will not drop if the market crashes. This is your emergency fund and your buffer against sequence of returns risk. Step 2, look at your portfolio allocation. If you are over 60 and you have 80 or 90% in stocks, that is likely too aggressive. Consider shifting some into bonds or cash. The classic rule is your age in bonds. So a 65-year-old might have 65% in bonds and 35% in stocks. Buffett's 90-10 rule is more aggressive, but he recommends that for people who will not panic and sell during downturns. Step 3, check your fees. Log into every investment account you have. Find out what you are paying in expense ratios, management fees, and advisory fees. If any single fund charges more than 0.5%, ask yourself why. There are index funds that charge 0.03%, that is 100 times cheaper. Step 4, maximize your tax advantages. If you are 65 or older, the new senior tax deduction gives you an extra $6,000 if you are single or $12,000 if you are married filing jointly. That phases out at higher incomes, but for most seniors, it is free money. Make sure you are claiming it. Step 5, understand your Social Security options. If you have not claimed yet, every year you delay past 62 up to age 70 increases your benefit by about 8% per year. That is a guaranteed return you cannot get anywhere else. If you can afford to wait. Step 6. Diversify your income sources. Do not rely on just one thing. Social Security, pension if you have one, investment income, maybe part-time work or a side business. Multiple streams of income protect you if any one source fails. Step 7. Have a written plan. Know exactly how much you need per month. Know where that money will come from. Know what you will cut if the market drops and stays down for years. Having a plan reduces panic when things get rough. Now let me address the elephant in the room. Should you sell everything and go to cash? No, absolutely not. That is not what Buffett is doing. Berkshire still owns hundreds of billions of dollars in stocks. Apple, Coca-Cola, American Express. He is not running for the exits. He is being selective. He is raising cash so he can buy when prices are better. The worst thing you can do is panic. Emotional decisions destroy wealth. Buffett's whole philosophy is about staying calm when everyone else is losing their minds. But there is a difference between panic selling and prudent rebalancing. If your portfolio has gotten too aggressive because stocks have risen so much, It makes sense to take some profits and reduce risk. That is not panic, that is wisdom. Let me also say this directly. The headlines about Warren Buffett issuing emergency warnings are largely fabricated. I have looked at the videos, I have read the transcripts. They are clickbait designed to sell you gold, newsletters, or some other product. They take Buffett's name and twist his message. But beneath the clickbait, there is a real concern. The market is expensive. Buffett's actions confirm that. History shows that expensive markets tend to deliver poor returns. Seniors are more vulnerable than younger investors to big drops. So ignore the fear-mongering, but do not ignore the fundamentals. Buffett himself remains long-term optimistic about America. In his recent interviews, he said he believes the country will continue to grow. American businesses will innovate. The economy will expand. But that does not mean every moment is a good time to buy stocks. His philosophy has always been about buying great businesses at fair prices. Right now, he is saying prices are not fair. So he is waiting. You should do the same. Not wait in the sense of sitting on the sidelines completely, but wait in the sense of being patient, staying diversified, keeping some powder dry, and not chasing the market higher just because everyone else is. There is one more piece of advice from Buffett that I want to leave you with. He once said, "The stock market is a device for transferring money from the impatient to the patient." If you can be patient, if you can hold through the downturns without panicking, if you can resist the urge to chase returns, if you can live below your means and invest the difference, time will work in your favor. That applies at 30. It applies at 60. It applies at 80. Buffett himself is 95 years old. He has seen every market crash since the 1950s. He has seen bubbles inflate and burst. He has seen fear and greed cycle back and forth. And through all of it, he has stuck to his principles. Low fees, long-term focus. Stay within your competence. Avoid debt. Do not try to time the market. Be patient. These are not complicated ideas, but they are hard to follow when the market is euphoric or when it is crashing. That is why most people underperform. They let emotions drive decisions. Here is what I want you to do right now. Take out a piece of paper. Write down how much money you have invested. Write down how much you could afford to lose without changing your lifestyle. Write down how you would feel if your portfolio dropped 40% tomorrow. If that thought makes you sick, you need to make changes. Not because the market will definitely crash. Nobody knows that. But because your emotional well-being matters. Sleeping at night matters. Not worrying about money when you should be enjoying retirement matters. Buffett has said, the first rule is not to lose. The second rule is not to forget the first rule. And the third rule is to avoid debt. For seniors especially, preservation of capital is more important than growth of capital. You do not need to double your money. You need to make sure your money lasts. So what is the bottom line? Warren Buffett has not issued a dramatic 2-day warning. That is clickbait nonsense. But his actions over the past 3 years tell a clear story. He thinks stocks are expensive. He is holding record amounts of cash. He is being selective and patient. You should be too. Build your cash reserves, reduce your fees, diversify your income, have a plan, stay patient. Do not panic. The market might crash tomorrow. It might keep going up for 5 more years. Nobody knows. But if you follow Buffett's principles, you will be prepared either way. That is what matters. Being prepared, not predicting, not timing, prepared. And one final thought. Buffett has spent 60 years building one of the greatest track records in investing history. He turned $1,000 into over $55 million at about 20% annual compounding. His net worth topped $150 billion. But you know what he says is his most important investment advice? It has nothing to do with stocks or bonds or cash. He says, invest in yourself. Read constantly, learn constantly, develop your abilities. That is the one investment that nobody can take away from you. That is the one investment that always pays dividends. So take his market warning seriously. Position your portfolio for uncertainty, but also invest in your own knowledge. Understand what you own and why you own it. That understanding will serve you better than any hot tip or market prediction ever could. Stay safe out there. Protect what you have built. And remember, patience wins in the end. Now, before you go, let me dig deeper into something critical that most financial advisors will never tell you. They will not tell you because it is not in their interest to tell you. When the market is at all-time highs, like it is right now, Wall Street makes more money. Financial advisors who charge a percentage of assets make more money. Hedge funds make more money. Banks make more money. Nobody in the financial industry has an incentive to tell you to be cautious. They want you fully invested at all times because that is how they get paid. Buffett does not have that conflict of interest. Berkshire Hathaway gets paid when their businesses perform well. They do not charge management fees. They do not take a cut of your portfolio. When Buffett tells you to be cautious, it is not because he benefits from your fear. It is because he genuinely sees something in the market that concerns him. And that is why his actions matter so much more than the talking heads on financial television. Let me break down exactly what is happening in the economy right now and why seniors need to be especially vigilant. First, interest rates. The Federal Reserve raised rates aggressively to fight inflation. That is good for savers in some ways. You can now earn 5% on Treasury bills, but it is bad for the economy because borrowing costs more. Companies with debt have to pay more interest. Consumers with mortgages and credit cards have to pay more. Higher rates eventually slow the economy. They always do. The question is not if, but when and how much. For seniors, higher rates create a paradox. On one hand, your savings accounts finally pay something. On the other hand, if the economy slows and the stock market falls, your portfolio could take a hit at the same time companies start laying off workers and reducing dividends. Second, national debt. The United States government is running trillion-dollar deficits every year. The national debt is over $35 trillion. Interest payments on that debt are now one of the largest items in the federal budget. This matters because eventually something has to give. Either taxes go up, spending gets cut, or inflation erodes the value of the debt. None of those options are great for retirees. If taxes go up, your retirement income buys less. If spending gets cut, Social Security and Medicare could be on the chopping block. If inflation rises again, your purchasing power declines. Buffett has been clear about his views on fiscal responsibility. He has said that the country cannot keep spending more than it earns forever without consequences. Third, the labor market. Unemployment is low right now. That sounds good. But historically, low unemployment often precedes a recession. Companies have hired aggressively. At some point, they may need to reverse course. For seniors who are still working part-time or considering going back to work, if their retirement savings take a hit, a weaker job market is concerning. Jobs for older workers are often the first to disappear during downturns. Fourth, artificial intelligence. AI is transforming industries at an incredible pace. Some companies will benefit enormously. Others will be disrupted and destroyed. The current market rally is heavily concentrated in AI-related stocks. The so-called Magnificent Seven, Apple, Microsoft, Google, Amazon, Meta, Tesla, and Nvidia, account for a disproportionate share of the S&P 500's gains. This concentration creates risk. If the AI hype fades or if these companies stumble, the index could fall even if the rest of the market holds steady. Analysts have warned that an AI bubble burst could gut retirement funds that are heavy in tech stocks. Many target date funds, the default option in most 401k plans, have significant exposure to these companies. Check your holdings. Know what you own. If your retirement fund has 30 or 40% in tech stocks, you are making a concentrated bet whether you realize it or not. Fifth, geopolitical risks. The world is less stable than it was a few years ago. Conflicts in multiple regions, trade tensions between major economies, supply chain disruptions that can spike prices overnight. Buffett has said he does not try to predict geopolitics, but he does acknowledge that shocks can happen, and when they happen, markets can react violently. For seniors who need steady income from their portfolios, violent market reactions are dangerous. You cannot afford to be down 30% when you need to withdraw money to pay for groceries and medical bills. Now let me give you a framework for thinking about all of this. It is not about predicting what will happen. Nobody can do that consistently. It is about preparing for multiple scenarios. Scenario 1, the bull market continues. Stocks keep rising, AI delivers on its promise. The economy stays strong. In this scenario, you still do fine if you follow Buffett's advice. A 90-10 portfolio with low fees will capture most of the upside. You will not beat the market, but you will participate in the gains. Scenario 2, a mild correction. The market drops 10 to 20%. It happens every few years. In this scenario, having some cash reserves means you do not panic. You can wait it out. Maybe you even buy a little more at lower prices if you have the stomach for it. Scenario 3, a major crash. The market drops 40 to 50% like in 2000 or 2008. In this scenario, your cash reserves are essential. Your reduced stock allocation protects you. Your diversified income sources keep you afloat. You survive and wait for the recovery. Scenario 4, extended stagnation. The market goes nowhere for years. Maybe up a little, down a little, but no real growth. This is what happened from 1968 to 1982. After inflation, investors made almost nothing for 14 years. In this scenario, dividends become crucial. Owning companies that pay reliable dividends gives you income even if stock prices do not rise. Buffett loves dividend-paying stocks for this reason. Coca-Cola, American Express. These companies have paid dividends for decades through good times and bad. No matter which scenario unfolds, Buffett's principles protect you. Low fees preserve your capital. Diversification reduces risk. Cash reserves provide flexibility. Patience keeps you from making emotional mistakes. Let me also address something I see too often with retirees. The fear of running out of money leads people to take too much risk. They think if I just get a higher return, I will be fine. So they load up on stocks or chase speculative investments. This is backwards thinking. The fear of running out of money should lead you to take less risk, not more. If you cannot afford to lose your nest egg, you should not be betting it all on stocks continuing to rise. Buffett has a quote that applies here. He says, "Risk comes from not knowing what you are doing." Most retirees do not fully understand the risks they are taking. They do not know that their target date fund is 70% stocks. They do not know that their portfolio is concentrated in a handful of tech companies. They do not know that a 50% drop would require a 100% gain just to get back to even. Education is the antidote to risk. The more you understand about your investments, the better decisions you will make. I want to take a moment here to acknowledge the emotional side of all this. Money is not just numbers on a screen. It represents security, independence, the ability to help your kids and grandkids, the freedom to live life on your terms. When the market drops, it is not just your portfolio that takes a hit. It is your peace of mind. It is your sense of control. It is your confidence in the future. Buffett understands this. He has talked about how important it is to invest in a way that lets you sleep at night. If you are checking your portfolio every hour and feeling anxious, you are probably taking too much risk. Find the allocation that gives you peace. Maybe that is 50% stocks, 50% bonds, maybe it is more conservative. There is no shame in prioritizing sleep over returns. I also want to talk about the importance of having a trusted team around you, a good accountant who understands retirement tax planning, a fee-only financial planner who does not earn commissions on products they sell you, maybe an estate attorney if you have assets to pass on. Buffett surrounds himself with people he trusts. Charlie Munger was his partner for decades. Greg Abel is now running Berkshire. Buffett did not try to do everything himself. Neither should you. But be careful who you trust. The financial industry is full of people who put their interests ahead of yours. Buffett has been outspoken about this. He specifically called out hedge fund managers and active fund managers who charge high fees while delivering poor results. Ask questions. Understand how your advisor gets paid. If they earn commissions, they have an incentive to sell you products. If they charge a percentage of assets, they have an incentive to keep your money invested even when caution is warranted. Fee-only advisors who charge a flat rate or hourly fee have fewer conflicts. They get paid the same whether you buy or sell, invest aggressively or conservatively. That alignment of interests matters. Let me now give you a simple action plan, something you can do this week to better protect yourself. Day 1. Log into all your investment accounts. Write down the total value. Write down what percentage is in stocks, bonds, cash, and other assets. Get the big picture. Day 2. Look at the fees you are paying. Check the expense ratios on every fund. Check advisory fees. Check any other charges. Add them up. This is money coming out of your returns every year. Day 3. Calculate your living expenses. How much do you need per month? Per year? Multiply by 24 months. That is how much cash you should consider keeping safe and accessible. Day 4. Review your income sources. Social Security, pension, dividends, interest, part-time work. Add them up. Compare to your expenses. Is there a gap? How will you fill it? Day 5. Talk to someone you trust. A spouse, a financial advisor, a knowledgeable friend. Discuss what you learned. Get a second opinion on your allocation and your plan. Day 6. Make one change. Just one. Maybe it is reducing fees by switching to a lower cost index fund. Maybe it is moving some money from stocks to bonds. Maybe it is setting up an automatic transfer to build cash reserves. One step forward. Day 7. Write it down. Your allocation, your income sources, your plan for different scenarios. Having it on paper makes it real. You can refer to it when emotions run high. This is not complicated, but it requires intention. Most people never do these steps. They let inertia guide their retirement. That is how people get hurt when markets turn. Buffett has spent his entire career being intentional about investing. He reads 5 hours a day. He analyzes businesses carefully. He waits patiently for the right opportunities. He does not react emotionally to market swings. You do not need to read 5 hours a day, but you should spend at least a few hours each year reviewing your finances. Is that too much to ask for something this important? Here is something else Buffett has emphasized throughout his career: the importance of thinking long-term while being prepared for short-term disruptions. He has said that his favorite holding period is forever. He buys great businesses and holds them through thick and thin. Berkshire has owned Coca-Cola since 1988, American Express since 1991. These positions have grown enormously over decades, but he also maintains enormous cash reserves precisely because short-term disruptions happen. The 2008 crisis, the 2020 pandemic. These events created buying opportunities for those with cash available. For seniors, this dual approach makes sense. Your core portfolio should be built for the long term. Low-cost index funds that capture broad market growth, dividend-paying stocks that provide income, a mix that matches your risk tolerance. But you also need to be prepared for short-term disruptions, cash reserves, conservative allocation, multiple income sources. These protect you when the unexpected happens. The current market environment demands both perspectives. Long-term, the American economy will likely continue to grow. Innovation will create new industries. Companies will earn profits. Stock prices will generally rise over decades. But short-term, valuations are stretched. A correction is possible, if not probable. And seniors cannot afford to be caught off guard. I want to close with a story that illustrates why Buffett's approach matters. In 2008, as the financial crisis unfolded and markets collapsed, most investors panicked. They sold at the bottom, they locked in losses, they swore off stocks forever. Buffett did the opposite. He wrote an op-ed for the New York Times in October 2008 with the headline, "Buy American, I Am." He said he had been buying American stocks for his personal account. He explained that a simple rule dictates his buying: be fearful when others are greedy and greedy when others are fearful. He acknowledged the uncertainty, but he said he was confident in America's long-term future. He was right. From the market bottom in 2009, stocks have risen enormously. Those who bought during the fear were rewarded spectacularly. But here is the key. Buffett could buy during the crisis because he had cash. He had been patient during the boom years. He had not chased overvalued stocks. He was prepared. Today, he is preparing again. The massive cash hoard, the net selling, the cautious commentary, all of it says he is getting ready for the next opportunity. You should be too. Not by trying to time the market, not by guessing when the crash will come, but by positioning your portfolio for resilience, by having cash available, by reducing risk to a level you can tolerate, by staying patient while others get greedy. That is the real lesson from Buffett. Not some 2-day deadline, not some secret warning, just timeless principles applied consistently over time. Low fees, long-term focus. Stay within your competence. Avoid debt. Be fearful when others are greedy. Be patient. Follow these principles and you will be prepared for whatever comes next. Whether that is continued market gains or a painful correction, whether inflation rises or falls, whether the economy booms or busts, you will be prepared. And that is what matters most. Take care of yourself, take care of your family, and take care of your finances by following the wisdom of the most successful investor in history. I will see you in the next video.